All right, welcome to our first ever liquidity pool analysis where we take a portfolio, a public wallet, and we analyze it through APY vision and show how a person's portfolio is performing in regards to concentrated liquidity pools. Now we're going to export the data from APY vision. We're going to import it into a spreadsheet that I've created and just kind of run through the numbers and the performance and just see what improvements can be made to help the individual out and see where they can fine tune and further hone their strategy. All right, so we went to APY Vision, we took the wallet, we exported it, right? Exported all the data, and I compiled it in here. So I've already done all that. For the initial deposit, I put $1 million because, I don't know how much they started out with, but with the average initial capital, that means the average staked into each liquidity pool was about $461,000. So I just took $1 million and put it there. So the column I here is going to be a little off, and I wouldn't take these numbers. I wouldn't look at these numbers here, these two numbers. Especially, but other than that, everything else is accurate. I went through the pools and everything is seems good. So ran the numbers and this is what we have. All right, so we have an initial stake, which means an average initial stake, which means the average amount between all these liquidity pools, which they have about 184 liquidity pools that they've staked and exited since January of 2022. So as of today, that's 507 days of providing liquidity in this wallet. So there's a lot of data here and a lot to go over. So it's really this could be very helpful for SolveMaxwell to see where they can improve. All right. Now this is going to be just a general overview. I'm not going deep into it, but hopefully it helps. All right, so on average, or the total amount of fees you've collected over this time period is $251,000, 285, as you can see in column B right here. The average yield per transaction, which means the average yield per liquidity pool, was $1,782. The amount of yield you've earned is about 54% on the amount invested, which means the average initial. So kind of taking an average of that. But the average gain or loss per transaction, which means it's taking, on column E, it's taking the amount you've staked minus the amount that was the value of your pool when you exited, and also taking account for yield on top of that. So on average, you're losing $2,331, and the average yield per day is $495 in yield. So let's kind of break this down here, right? So we're looking at the total gain over here, column H. It's showing minus $405,000 in that time frame. This is your liquidity pools when you exited, the amount of yield you had generated in that time. And, this is not taking into account, if you've traded, any trading, buying or selling, right? Or even yield farming on different platforms that's not supported by APY Vision. This is, what I'm saying here is all Uniswap. So if you have any other liquidity pools, so your total amount or your total performance is going to be a lot different, but we're just taking specifically your Uniswap strategy, your concentrated liquidity pools. So you've lost that much in Uniswap. And looking over here, the total of impermanent loss that you've had versus yield. So this is, say we're looking at your portfolio here, and say we had someone else follow exactly what you did, but instead of providing liquidity with those tokens for each pool, they just held the tokens and entered when they bought them when you entered, and they held them in their wallet. They didn't provide liquidity, so they just hodled. And then they exited when you exited, right? They closed out the position when you closed yours out. So they outperformed you by $273,000. So you've lost $273,000 more than someone that would have just hodled their position. Now, and this is a good example to show a lot of people in the space, they write off using concentrated liquidity pools to generate yield and use it as a way to just generate profits, right? They cite impermanent loss. They say it's this is why it doesn't work, right? It's better to just hodl, right? And this shows exactly that, right? But what I can tell you here is already the strategy here when you're exiting and entering the pools, it's not the biggest change you can make here from what I'm looking at is thinking of your portfolio as a holistic strategy, right? As a holistic overall portfolio, all your liquidity pools working holistically and working together. I call it liquidity pool grouping, which means that if you had a trade idea, right, and you're like, okay, I want to get into Ethereum USDC, right? I want to stake my liquidity in there. You had some idea about the market, right? I don't know what it is, obviously, but you had an idea of where the market was going, and you had some sort of bias, right? You had some sort of analysis, right, that allowed you to jump into this pool. That's what I'm thinking. I mean, unless you're just jumping in, right, which is without a plan, that's even worse, right, because you don't have a plan. But let's just say you had a bias and you jumped in. Now, the trade idea is working, right? You exit the liquidity pool, and if the trade idea is still valid, and say your pool is going out of range, or you need to rebalance just to kind of mitigate risk, the second pool you initiate based on that trade idea has to work together with the initial liquidity pool. You have to stake your liquidity in order to be able to have them work together, so that one of three things will happen, right? Say like you staked a liquidity pool when Ethereum was at $2,000, and you staked an Ethereum USDC pool. Trade idea is working, right? Price falls to like say 1,800, and you go to rebalance your liquidity pool. Well, the second liquidity pool that you stake after you unstake the initial pool, and then you rebalance and stake it, that pool, one of three things must happen. Either one, when price gets back to 2,000, I mean, if it gets back, right? We don't know if it would, but the idea is like, if it gets back, you either want to be break even, you want to be in a profit. You could be in a very big profit, or you could be in a little bit of a profit, or you could take a little bit of a loss back at break even, right? At the initial, at 2,000, right? You could be in a little bit of a loss. Now, the difference between those three is that when you're break even at 2,000, that means you're just generating yields and you're looking to profit off the yield, right? And that's your main goal, is to use yield generation, because break even at 2,000 doesn't take into account the yields you've generated. So that would be your profit, right? And you could kind of run a strategy that way. But if you want to be more aggressive and say you want your liquidity pool to also be in a profit in addition to your yield when you get back to $2,000, then you want to hold or even buy more Ethereum, or a combination of the two, right? And that comes with proper pool structuring, right? Pool structuring, rebalancing, understanding the mechanics of how impermanent loss works, to be able to stake your pool and understand that, okay, at 2,000, I'm going to be in this much profit. All right. This is my goal, right? In the trade. And then the third option, if you want to be in a little bit of a loss, now you're probably wondering, like, why would I want to be in a loss back at break even? Well, there's a trade-off here. say in the second pool where you want to be aggressive, the trade-off, yes, you will be in a profit at 2,000, but what if price drops further? You're taking on more risk because you have more Ethereum in your pool. If you decide to go with the third option and be at a loss at 2,000, then that means you're selling off more Ethereum, right, to USDC. And that way, if price does continue to drop, you're not taking too much of a hit, as much of a hit as you would with the aggressive pool, right? Because you don't have a lot of Ethereum in the pool. So there's a time and a place for each one of these, right? Not one or the others is not better than the other, right? It all depends on your strategy, right? And your risk tolerance, what your market analysis is saying. So as you can see, what I'm teaching here is not specifically like my strategy, because my strategy, the way I run my liquidity pools, isn't going to work for everybody. And it might not work for you. It might work for you, but it might not work for everybody. And 99.9% of the people, it probably wouldn't work for. And the reason why is because it works for me. And what I mean by me is me as a trader, me as a person, me as someone with the amount of time I have to manage it, right? For me, I don't want to be too active. I manage my pools like once or twice a month. So I'm not very active in it, right? Last year I was more active. Yes, absolutely, I was more active, and that's because I had more time to it. But I'm doing some other things right now. So I decided to put off and give up some of the yield generation by making my pools wider and giving up some of that APR, but still in the game, right? And managing it that way, right? So I'm not as aggressive nowadays. But what I'm seeing here is that I don't, like, especially if you've been farming since 2022, January 2022. You know, let's look at the chart. Let's kind of go back here. Let's kind of go to the weekly view here. And we're going to go over here. Okay, so we're looking at the weekly chart here of Ethereum. And you started about January 6th, right? Around that week. Ethereum was about almost 4 grand, right? 4,000 Ethereum. And I was farming during that time too. So the yields were high. But yeah, also in your portfolio, you farmed a lot of different pools, a lot of altcoin pools. So did I. You know, it's the yields were insane during that time, right? I mean, hundreds of percent easily on altcoins, and even on Ethereum pools, you could see 100, 200, 300% APRs. So it was like, wow, this is really great. But yeah, we had this eventual drawdown just week after week after week. So this really pounded in, right? But so just kind of going back to your strategy, right? Take this and just understand that, okay, more is not always better. And what I mean by more is more variations or variety of liquidity pools. Like some good ways to initiate and really understand what you want to invest in is you want to be in a pool where you don't mind owning that token, right? First off. But if you're just in there for the yield generation, that's fine too. You just got to understand the mechanics of it and understand how impermanent loss works, because, you know, as you can see here, it really hurts you here in column J, right? You may as well have just hodled. You would have saved yourself $273,000, right? So understanding how impermanent loss works is very important. And this is something that, like, especially, I'm not sure if you were tracking your pools or not, but if you weren't tracking your pools and tracking the performance, you wouldn't have noticed it, because it's such a small amount over time, right? It's such a small amount that you really don't notice it. And you can see, because on average, you're losing $2,331. You're just like, taking a loss here, taking a loss, right? But these yields that are generating, you're like, wow, this is a big yield, right? So you're just like going at it, right? But over time, it's very difficult to see, especially if you're not tracking it, right? It's very important to really display and see what's going on and really track performance. Like for me, like I've been trading the markets since 2009, since the last financial crisis, and one thing that I've learned is that you have to track performance, right? There's no way around it. Like I know it's a lot of work, right? But you're not going to understand exactly like how you're doing, right? Like even like if you look at the greats, right? The great athletes like Tom Brady, Michael Jordan, right? Like these guys, they review tape, they review what they're doing and fine tuning and honing and going back and doing the reps and getting in there and consistently developing and honing their strategy, right? If they weren't reviewing the tape, if they were just kind of playing the game, going home, right, they probably wouldn't be noted as one of the greats, right? So just understand, like, I'm not saying this is going to make you like great or anything. I'm just saying that to give yourself the best opportunity, you have to track performance, right? It's very important because not sure if you knew that, you've lost this much, who knows, right? Because, there could be other things you could be doing in your wallet that you're profiting from, right? So numbers could be a lot less, right? Or you could be in profit, right? And not notice. But, according to Uniswap V3, this is how much you've lost versus someone that's hodled, right? The total amount you've lost is over here, it's a little higher. But, for a hodl portfolio, someone that's in crypto, comparing to providing liquidity, this is the number in column J that I would be more concerned about. Understanding how to outperform that hodl portfolio and minimizing impermanent loss. So it's very important. But I know this video got a little long, but that's kind of like an overview, right? And just if you can dig down and have the free Discord, ask questions. But if you can really understand that, okay, how am I going to control, how can I minimize the impact of impermanent loss? What do I need to do in order to fix this and structure my pools to be beneficial to me? Because at this point right now, it's going to be very difficult, and what you're depending on here is simply yield to pull you out of that hole, right? That hole of impermanent loss. Now, yes, we have fallen from when you started, about 50%, right? We're about 50% from where you started, right? 50% lower. But at the same token, how much yield have you earned, right? So 50% would be about, on average, 461,000, right? A hodl portfolio would have lost about $200,000, right? But the total yield you've earned is 251,000, right? So if only, not only understanding impermanent loss, but also understanding pool structure to be defensive, to shield yourself from delta, using delta hedging when needed, right? I don't delta hedge all the time because it's not beneficial to do it all the time. But there are times when you need to do some delta hedging, right? Because what I teach is time in the market, right? Like, to be successful in providing liquidity, you have to be in the market as much as possible, right? You need the time in the market to keep generating yields over time and keep generating. But in the meantime, you have to minimize risk. You either do that through proper pool structuring or delta hedging, right? And this is what's going to help you avoid large drawdowns. Of course, it prevents you from partaking in the upswings too, but it's more important to control risk. And when your market analysis lines up to where, like, okay, things are getting a little more bullish, I'm a little more bullish, I'm ready to take on some risk, then you can adjust your pools to be more aggressive and to take on more of a larger position to benefit from price upswings or rallies, right? So hopefully I'm going to stop it there, but I think, I think I've said quite a bit here, and just let it digest and just really understand that what I'm seeing here is impermanent loss is really eaten into your portfolio, right? And the lack of having a holistic portfolio view to let your liquidity pools work together, right? Right now they're just kind of clashing. You close one out. Say like you get into Ethereum USDC at 2,000, it draws down to 1,800. You close it out, rebalance, but you sell off too much Ethereum, right? And then price moves back up. Now, not only did you take impermanent loss on the way down, but now you're taking impermanent loss on the way up. It's a double whammy, right? Instead of taking impermanent loss on the way down and then recapturing that impermanent loss on the way up, that's what you're looking for. That's what you're looking to do. All right, so leave it there. If you have any questions, we can chat in Discord. See ya.